Welcome. I'm in conversation with Craig Chan. He's the head of emerging market strategy at Nomura. He's here with us in a special discussion this afternoon. Craig, thanks very much for taking out the time and speaking with us. I want to start off with a very simple question. What is the approach for emerging markets as we step into 2019?
Sure. I mean, we're looking at an environment where we believe high yielders will actually do better than low yielders. Now, just to put this in very quick context, we are looking at a slower US economy. We look at China slowing down as well, at least into the first half of the year. We believe that the Fed cycle is at a very mature phase. The whole kind of global policy normalization theme is looking like it's reaching a mature phase. And then, of course, we are looking at credit risks building because of slower growth. And when we take all these factors into context, as I mentioned, it's the high yielders which we believe will do better. A lot of the low yielders that we look at are exposed to the China risk, slower global growth, and also to high levels of domestic credit debt.
In light of what you just said, where would you place India from an investment point of view?
So India has, I've been recommending actually investors to be long the rupee. This was mainly premised at the start of the year where I felt that a lot of the negative news was in the price. RBI governor resigning, concerns about growth, concerns about populism coming through as well. I would say that at this point in time, I'm cautiously positive. Particularly as we run through into the budget. I think it will be a prudent budget, at least in the headlines, which could be positive for the markets. But the key risk is going to be running into the general elections in April, May. And of course, that will be potentially a key turning point for local markets, including the currency as well.
When you look at China and the developments there, do you expect abrupt sell-offs in emerging market currencies because of what news flow comes out of there in relation to US as well as its own domestic growth?
So I would say in the short run, I actually believe that the positivity can come through. I'm looking at a potential agreement to come through from the US-China front on trade protectionism. And I think it's in both sides' interests for this to happen. I think that will be an event that could even come through as early as the end of this month when the Chinese Vice Premier goes to the US. But if not, it's likely to happen before the deadline where they may increase the tariffs, and that will be the end of February. Having said that, I think medium term we are concerned about China. We're concerned about the macro environment weakening. It's not just about the external sector, it's not just about tariffs, but it's also about the high levels of debt, potential slowdown in terms of the property market, credit risks rising. That to us would slow down China's growth throughout the whole of this first half before the government will have to take on more stimulus around the May period of this year, which of course could bode very well for local markets then. But I think the scope and the time frame for a significant sell-off in Chinese assets is going to be very short. The positivity around trade, I think that could run on for potentially a month. But then, of course, the stimulus that could come through around May and stabilize markets, will be overall, I'd say, positive for Chinese financial markets and the currency.
How do you expect to see foreign money churning within the emerging markets, and where is the allocation maximum, according to you, by the time we turn to the second half of 2019?
So I say that the foreign investment is going to be going to the high yielders in particular. We've already seen some signs of that happening. Whether it's going to markets such as Turkey, whether it's going to markets such as Indonesia, that is already happening. I believe that will be a kind of consistent theme that comes through this year. The global environment is extremely supportive of high yielders. As I mentioned, global policy is near its peak. Global growth is slowing. There's less kind of divergence that's going on. emerging markets high yielders are sold off substantially as well. So I think the attractiveness on a valuation basis has substantially increased. This is where the money is going in. I think this is where the money will continue to go in, even through the second half of next year. But the second half of next year, if we do get the Chinese stimulus coming through around the end of the first half, then I think the low yielding environment, the kind of external dependent, Chinese dependent markets, which will be Korea, Taiwan, Singapore, Malaysia, would actually have the potential to do quite well there. There'll be a bit of catch up, but on a net basis for the full year, it looks like to me high yielders will do better.
Would you place India within that high yielding pack?
I would say there will definitely be periods where there will be opportunities. The concern we have will be around the general election time. But you know, the assumption we have and the baseline we have is that if the Modi coalition comes out with a slimmer majority, then the markets will rally very strongly on the back of this. I think India has been very punished last year. I do think that valuations are looking very attractive, particularly on the FX front. I think foreigners have definitely exited the market last year. There is space for reinvestment into this market. I think that if we can get through this election on a positive tone, the money will come back and India will actually perform very strongly, particularly in the second half of the year.
What's the key risk, according to you, for probably investments even into the bond market? You know, when we're running a risk on the twin deficits, on the fiscal as well as on the current deficit side, and now that we're talking about you know, the government taking populist measures and doling out SOPs for farmers, that could have a slight of a bearing on the fiscal calculation and the fiscal math. How would that play out?
Yeah. No, so definitely. I mean, it's not just going to be about the headline numbers that come out in this interim budget. It's going to be about the details. So the devil will be in the details. So people will be obviously looking at, you know, the potential revenue generations, you know, whether some of these assumptions are realistic as well. So we have to really judge after that whether you know, this is going to be something that's sustainable. Obviously, there's been discussions about, you know, transfers as well from you know, the central bank to the government. Again, that is a potential in terms of achieving its fiscal position. But I'd say on the global side, you know, what is the risk to the view on the global side? I think the risk would be if we're wrong about the you know, the length of the pause from the Fed. If we're of the view that, you know, inflation, wages start picking up rapidly, doesn't look like, for example, the slowdown economy actually pulls through to the real data, it's only really the survey data that's deteriorated, then there has to be some repricing from the global side as well. So that could be a negative driver. But I think, you know, at this point in time, we are of the view that it's a pause. The pause could be more prolonged. And then on the local factors within India, we have to really watch out for the details in the interim budget.
Just one last question, Craig, before we wind this up. What's your view on the Indian rupee? Obviously, there are key challenges and vulnerabilities with regards to what's going to happen with crude oil prices and thereabouts, the implication for the currency, portfolio outflows and their implications. But what is the fair value, according to you, that you have pegged for the currency?
So based on our valuation models, the currency, as in India rupee, is around 7% undervalued. So you have to be obviously careful on how we measure valuation, but we have 4 models which we use, and the average undervaluation is around 7%. Now, I would say that if we can move into a positive scenario on the political front, given that we have had a lot of negative news come out and negative developments, the potential for inflows to pick up in the global environment that we're in is huge, which means to me that combined with a positive outcome on the elections, we could actually see dollar India trade down to even like the 68 to 68.5 level by the end of this year.
All right, that is a very interesting take on the currency. Currently trading around 71 to the dollar. Craig, thanks very much for taking out the time. Appreciate it.
Thank you.